Hello, everyone, and welcome to another episode of the Profit Plus podcast. I'm your host, Kesha Hill, and today we're diving into common accounting mistakes and how to avoid them. Whether you're a seasoned business owner or just starting out, understanding and avoiding these mistakes can save you time, money, and stress. Before we dive in, I'd like to remind you to subscribe to our podcast, leave a review, and share this episode with anyone who might benefit from it. Now let's get started. Welcome to the Profit Plus podcast. This podcast is where we will explore the world of accounting and finance. I'm your host, Kesha Hill, and each week we will dive deep into practices, insights, and stories that inspire you to master the art of accounting. Whether you're seeking clarity in complex financial concepts or looking to advance your accounting career, you're in the right place. So sit back, grab your calculator, and join us on this journey to accounting excellence. Let's get started. Accounting is the backbone of any successful business. Proper financial management ensures that your business remains solvent, compliant with regulations, and poised for growth. However, even the most diligent business owners can make mistakes. Today, we'll cover some of the most common accounting errors and provide tips on how to avoid them. The first thing we're going to talk about is inadequate record keeping. So our first topic is inadequate record keeping. This is one of the most common mistakes, especially for small businesses and startups. Poor record keeping can lead to financial discrepancies, tax issues, and cash flow problems. So there's three mistakes that we're going to talk about. The first mistake is failing to keep receipts and invoices. Without proper documentation, it's challenging to verify expenses and income, leading to inaccurate financial statements. Number two, not tracking expenses and income properly. Inconsistent tracking can result in missing or duplicated entries, which will distort your financial picture and ultimately could cause you to pay higher taxes. Number three, mixing personal and business finances. Combining personal and business expenses complicates tracking and can create issues during tax season. We're going to talk about how to avoid these issues. Number one, we're going to implement a system. We're going to use an accounting software like QuickBooks Xero or FreshBooks. These tools can help you automate and simplify your record keeping. Next, number two, we're going to separate accounts. Always keep your personal and business finances separate. This helps in accurate tracking and reporting. So you want to make sure that you have a personal account and a checking account. You need to have a personal savings and you need to have a business savings. So right from the start, you should have at least 4 accounts so that you can keep business and personal separate. You also want to do number 3, which is have regular updates. Update your records regularly, ideally daily, but weekly will do. I would suggest that you don't go anything past 2 weeks, meaning bi-weekly, because what happens is it will prevent backlogs and errors, and therefore you can address any issues that may come up, or even better, you won't forget what a transaction may have been for. So by addressing these common mistakes and follow these strategies, you can maintain accurate financial records, ensuring your business runs smoothly and remains compliant with financial regulations. So now we're going to talk about misclassifying any expenses. So what you want to do is to make sure that this mistake doesn't happen, you want to make sure that you do not have inaccurate financial statements, which can lead to tax issues. It's crucial to categorize expenses correctly to understand your financial health and ensure compliance. So there are 3 common mistakes that can happen. Number 1, mixing capital expenses with operating expenses. Capital expenses are long-term investments, while operating expenses are day-to-day costs. Mixing them up skews your financial statements. An example of a capital expense would be purchasing a vehicle for your business. Or if you have a building, purchasing a building, or if you've done improvements to your office space. Those would be examples of capital expenses. Number 2, misclassifying personal expenses and business expenses. This can lead to inaccurate deductions and potential legal issues, complicating both accounting and tax reporting. If you were to be audited and you had personal and business expenses mixed together, the IRS could make your business a hobby and not actually a business because you have commingled those funds. So you want to make sure that we do not mix business and personal funds together. Inaccurately categorizing tax-deductible expenses. That's going to be number 3. Misclassifying these can result in misdeductions or issues during audits affecting your tax liabilities. Now we're going to talk about how to avoid these particular issues. Number 1, your chart of accounts. You want to create a detailed chart of accounts specific to your business. This helps in correctly categorizing each transaction. Number 2, training. You want to ensure that you and your accounting staff are trained in recognizing different types of expenses. Like, for example, travel. Your travel expenses should go under travel. Your meals and entertainment should go under meals and entertainment. If you have travel expenses that are related to a conference, that should go under your conference expenses. Your travel expenses are going to be traveling back and forth to a client or customer's location. That's going to be your travel expenses. If you had to travel, say if you're an attorney and you traveled and you had to pay for parking to go to the courthouse, that's going to be a travel expense. But if you went to, say, the bar association and they had some type of a conference and you had a hotel stay and you had to pay for the conference and you had flight expenses, all of that's going to be wrapped up into the conference. So you want to make sure that your staff, as well as yourself, is trained to know what needs to be categorized where. You also, number 3, should consult an expert like myself. When in doubt, consult with an accountant to ensure proper classification. Misclassification can be tricky, but with the right tools and knowledge, you can avoid these pitfalls. Now we're going to talk about neglecting doing your reconciliations. This is going to be the 3rd common mistake, is neglecting doing your reconciliations. Reconciling your accounts regularly ensures that your financial records match your bank statements, which helps identify discrepancies early. There are 3 common mistakes. Number 1, ignoring monthly bank reconciliations. That's your bank accounts as well as your credit card accounts. You should be looking at those monthly. In addition to those particular accounts, you should also be looking at any liability accounts like your loans. So you want to look at all 3 of those if you have them. Number 2, overlooking credit card and loan account reconciliations, which I mentioned in number 1. So we also want to make sure that we're looking at those as well, the credit card and loan statements. We want to make sure that we are categorizing the interest that we're paying on credit cards as well as loans. Not reconciling the accounts receivable and the accounts payable, those can also be common mistakes as well, because sometimes you can miscategorize something, but if you reconcile the accounts payable or accounts receivable, you'll notice that, oh, this customer paid, or maybe you know that that customer is not going to pay, or maybe that customer canceled their order and you still had it showing on your books that you are supposed to receive that money. So that's why it's important to make sure you reconcile your accounts receivable as well as your accounts payable. How do we avoid these particular pitfalls? So we have 3 things that we can do to avoid the pitfalls. We want to schedule regularly to reconcile all accounts. Ideally, you want to do it monthly. Normally, your bank, credit card, and loan statements come toward the end of the month. Sometimes they come in the middle of the month. But what you can do is at the end of the month, so we are in August of 2024. So since we are in August of 2024, we should be looking to reconcile July. So we want to pull all of those July statements and reconcile July. So what happens with reconciliations, you're looking at the month behind. So being in August, we're looking at July because we want to reconcile everything that happened in July so that it'll be clean for July, and we're looking at the financial statements for July to see if there were any discrepancies or if there's anything that we need to do, like cancel subscriptions or things like that. So that's why we want to make sure that we're looking. Or did we cancel a subscription and they still continue to charge us? We won't know this unless we look and we do these reconciliations on a frequent basis, which ideally I recommend on a monthly basis. Now we have number 4, which is failing to plan for taxes. Failing to plan for taxes is another common mistake that can lead to financial strain. Tax planning should be an ongoing process, not a last-minute scramble. So here are 3 common mistakes: underestimating your tax liabilities, not setting aside funds for taxes, missing out on tax deductions and credits. So let's talk about how to avoid those 3 common mistakes. Number 1 is tax planning. You're going to want to work with a tax professional to develop a tax plan that includes estimated payments and potential deductions. Number 2, budgeting. We want to include tax payments in your budget to ensure you have funds available when needed. And number 3, you want to stay informed, meaning you want to keep up to date with the tax laws and regulations that affect your business. One suggestion that I have, if you don't have a tax professional as of yet, what I suggest that you do is to take about 15 to 20% of whatever you make, whatever your income is, and open up a tax savings account at whatever bank that you use for your business and put at least 15% aside. Until you can get to that tax professional, at least you'll have it put aside. So therefore, there's not a huge surprise when you have this tax bill. You would have been putting at least 15% aside, if not 20% aside, into a savings account. So when you have to pay your taxes, you do have money set aside to be able to do that. Number 5, we're going to talk about ignoring your cash flow management. Ignoring cash flow management is a mistake that can cripple a business. Cash flow is the lifeblood of any business, and managing it effectively is essential for survival and growth. And again, my magic number of 3, we're going to talk about 3 common mistakes. Number 1, not monitoring your cash flow regularly. Number 2, overestimating revenue and underestimating expenses. Number 3, failing to maintain a cash reserve. How are we going to avoid this? For a cash flow statement, you want to regularly review your cash flow statement to understand your in and outflows of cash. So how your cash comes in and how your cash comes out. You want to make sure you understand when money comes in and when money comes out. We also want to talk about forecasting. You want to create a cash flow forecast to anticipate future cash needs to prepare for shortfalls. And how you want to do that is you can do a spreadsheet or you could do paper and pencil. You want to look at your last 3 bank statements, credit card statements. You want to look at your bank statements for all of your cash flow that comes in. How much money are you bringing in on average? So if you take all the money that came in, add those 3 statements of money that came in, divide it by 3 to get your average. That's going to be your average. Let's just say it's $20,000 is your average. So now you want to say, okay, it's $20,000. We're going to say, to be conservative, we're going to say $20,000. That's what we're going to get on average every single month. Then you want to look at your 3 months of expenses. So you need your bank statements and you need your credit card statements, and you want to add up all of those costs to see what your costs are, all of your expenses. You also want to look at where you can cut expenses while you're doing this process. Then you want to list out all of your expenses. If your expenses are less than your income, That's good because that means you have a positive cash flow. If your expenses are more than your income, that means you have a negative cash flow. And what you need to do, one of two things, either A, you need to decrease those expenses, B, you need to increase your income, or C, you need to do both. And the third thing is you want to maintain a cash reserve. You want to keep a cash reserve for emergencies and unexpected expenses. What I suggest that you do is take 5% of your monthly income and put that into a general savings account for your business. That way, you always have a little something set aside for a rainy day. Effective cash flow management can mean the difference between a thriving or a struggling business. Now we're going to talk about overlooking your financial analysis. And this is going to be the last segment of this podcast. Simply recording transactions isn't enough. Analyzing your financial data is crucial for making informed decisions. Here we go with the number 3 common mistakes. Failing to review financial statements regularly, not using financial ratios and KPIs, and ignoring trends and patterns in financial data. How we're going to avoid that? Number 1, we're going to have regular reviews. You want to schedule regular reviews of your financial statements at least quarterly. I suggest you do it monthly, but if you're unable to do it monthly, then do it quarterly. Just put a date on the calendar. Say, maybe the 10th of every month or the 15th of the month. Or you'll do it every 3 months, but pick a date and schedule it and make it a date for yourself. Put it on your calendar and do it for 15 minutes or maybe a half hour. It's going to be detrimental to your business if you continue to overlook this. Number 2, you want to utilize financial analysis tools and software to gain insights from your data. And basically what that means is you can use tools like QuickBooks or Xero, or you can use spreadsheets. That's up to you. Or you could use someone like myself at Tailored Business Solutions. We would be able to help you with this financial analysis information and to be able to educate you on what your numbers are telling you. Shameless plug. Number 3, consult experts, which was my shameless plug. You can work with financial advisors or accountants like myself to interpret your financial data and make strategic decisions. So financial analysis is key to understanding your business's financial health and making proactive decisions. We've covered a lot today, from record keeping and expense classification to reconciliation, tax planning, cash flow management, and financial analysis. Avoiding these common accounting mistakes can significantly improve your business's financial health and ensure long-term success. Thank you for joining me on this episode of the Profit Plus podcast. I'm your host, Kesha Hill. If you enjoyed this podcast episode, be sure to subscribe, leave us a review, and share this podcast with anyone who might benefit from it. Until next time, keep pushing forward, stay curious, and remember, success is just around the corner.